Hello, everyone, and welcome back to the newest edition of the Bull Time Investor. Glad to have everybody here again today. And we wanted to touch on a topic that we'd gotten some questions on from the last time we'd asked people what they wanted to hear about. So we're going to touch briefly today on the different types of retirement accounts and why they're all beneficial. So there are essentially two types of investment accounts or retirement accounts that you could open up if you're not using a company-sponsored or what's considered a qualified plan. And we'll talk about that at the end here as well. So you really have two options in which you can do it. The first one is what's considered a traditional IRA. A traditional IRA is one of the oldest retirement accounts that was developed. And essentially what happens is that you're putting money into the retirement account pre-tax. So for example, let's just say if you want to put $500 in per month, then at the end of the year, what you would do is you would take that amount and it would be an offset against your adjusted gross income. So it would actually be a way for you to limit your tax liability right now. So what you're essentially doing is you're betting on paying taxes later in retirement. So the money comes out pre-tax, and then as it's in and you're invested into a portfolio of well-diversified assets, all of those assets then grow tax deferred. And once you hit the magic number of 59 and a half years old per the IRS, then you can start taking qualified retirement distributions as income. At that point in time, you would then pay taxes at your ordinary income tax bracket. So on the traditional IRA, what you're doing is that you're not going to pay taxes now. All that money is going to grow tax deferred. And then in retirement, you're going to have to pay taxes after the age of 59 and a half or when you start taking distributions. If you elect to not take distributions, traditional IRAs have what are called required minimum distributions. And a required minimum distribution, or sometimes you'll read in a magazine or see on TV or hear somebody call it an RMD, essentially is an IRS governed thing that basically says that now it's time for you to start taking distributions because you've been deferring taxes this whole time, so Uncle Sam can start getting his take. So those RMDs start at 70 and a half. So even if you don't need distributions, you have to start taking them at 70 and a half years old. They're based upon the prior year-end's balance and a factor on your age. So it's not just a magic number. There is actually a formula. And then you would pay taxes on ordinary income at that point in time. Some people do some tax advantage savings on those. For example, if they like to tithe to a local parish or give money to a non-for-profit, that is a way that you could actually take the RMDs, give them to the non-for-profit organization, and nobody actually has to pay taxes on those distributions. So that's essentially how a traditional IRA works. You then have kind of a new school way, and that's what is a Roth IRA. A Roth IRA was developed, it's kind of reverse of a traditional IRA. So as opposed to not paying taxes now, you essentially do pay taxes now. So you're making contributions into a Roth IRA with post-tax money. Why that's advantageous is now you're getting the taxes out of the way. Never have to pay taxes again. And as the monies are invested into a properly diversified portfolio of stocks, bonds, whatever it is you have in there, all of that money then grows tax-free. Once you hit 59 and a half, again, that's the magic age for retirement, and you start to take those distributions from the Roth IRA, all of those distributions are then tax-free because you've already paid taxes. One other nice caveat on the Roth IRA is that there are no required minimum distributions. So if you want to leave the money to family or you want to bequeath it to someone else, there are not going to be any more income taxes paid on that. All of that money comes out tax-free. So no required minimum distributions, tax-free growth, and pay your taxes now when it goes into the Roth. So those are kind of the key differences between traditional IRAs, Roth IRAs. People often ask us, which ones are better? It's really tough. Obviously every situation is different. We always like to harken back to everybody's financial plan because it looks back at what's your tax picture look like, what are you trying to achieve. I will tell you the general rule of thumb for us at Financial Partners is we like a majority of our households to have one of each. Even if you're not funding both, it allows us, as we get into and closer to the pre-retirement phase or pre-retiree phase and then into post-retirement phase, start doing things like conversion, so moving some of that traditional IRA money into Roth IRAs, so we can start paying a little bit of tax on those transfers now, or those the conversions now, so that we don't have to pay taxes later. We want to make sure to work with your CPAs or your tax professionals so that we're not bumping a tax bracket up for you, but a little bit more deeper dive into kind of tax planning. But generally, rule of thumb, like I said, at Financial Partners, we recommend that you have one of each. There are advantages to both. Some people think taxes are not going to go up. Some people think taxes are going to go up. And obviously, we don't know the answer to that. So we just wanted to provide you with a little bit of basic information on both of the types of retirement accounts that you could have. Obviously, there are a few more, but these are the two basic ones. So as always, if you have any questions, please feel free to reach out to us at the office here. Check us out on Facebook, YouTube, and on our website. So for now, thanks for joining us, the Full-Time Investor. Until next time.